to another edition of Trust Issues by Kepler Trust Intelligence. In this podcast, we speak to leading investment trust managers about the philosophy behind their strategies and the themes that are shaping their portfolios. Today, I'm joined by Matt Ridley, partner at Schroders Greencoat and co-manager of Greencoat UK Wind, which has the ticker UKW. Schroders Greencoat manages £10 billion of infrastructure assets invested in or managed across 7 funds. UKW was the first of the UK's renewable energy infrastructure trusts to list back in 2013, and it's now the largest in the sector with net assets of around £3 billion and a market cap of around £2 billion. The wind farms that UKW owns generate approximately 2% of the UK's electricity, and since IPO, it has paid a total of £1.4 billion in dividends, leading to net asset value total returns of around 190% to the date that we're recording this podcast on the 1st of June 2026. Matt has 22 years of investment management experience, including 16 years focused on UK wind projects. He joined Greencoat Capital in 2021 and manages UKW alongside Stephen Packwood. Matt, thanks for joining me today.
Thanks for having us, David.
Now, I wanted to kind of just try and get back to basics, if at all possible, today. So I'll start with what's fairly simple and potentially stupid question, given the name of the trust. What exactly does Greencoat UK Wind invest in?
So UK Wind is fundamentally a simple business. It was set up in 2013 to provide access to ownership of wind farms, and that is all we own, UK wind farms. And we have interest in 49 of them dotted around the country, offshore as well. It's a very simple model. The wind farms produce cash. We use that to pay an inflation-linked dividend to our shareholders. That's the 1.4 billion so far. It's always a number that staggers me every time I say it. And we reinvest the rest. And so far, we've reinvested £1 billion back in the business. And as you said, the business is valued at around 3 billion. And this year's dividend offers shareholders 10.7 pence per share, or a yield of around 11% on today's share price.
And can we just talk about kind of wind for a second? Now, clearly, as with any type of renewable power, wind is variable. It will blow for some of the year. But obviously, last week, we had a lot of hot weather and what seemed like very little wind. Does that make the portfolio itself cyclical through the year? And what are the dynamics in terms of UKW being focused on one type of weather condition?
So despite being a wind fund, we are allowed to enjoy sunny weather. And it was a very nice week. Look, you're right. So renewable resources are variable. And over a short period of time, they're very variable. So over a year, say, we might expect the variance in production to be plus or minus 10%. But importantly, over 20 years, and this is a long-term ownership fund, the variance drops significantly to around plus or minus 2%. And we can see that in our operating history. If we look at last year, wind speeds were about 7% below long-term averages. And so far this year, our generation is 4% above average. So variability is normal, but over the long term, it reduces significantly. And this is also one of the reasons that we structure our dividend to be well covered, so that it's not a threat in the sort of leaner wind years. And we've delivered over time. Our average dividend cover has been 1.7 since launch in 2013.
And digging into the assets and the portfolio a bit more, a couple of key questions spring to mind. First is how UKW makes money from the assets it owns. And also, how does Schroders Greencoat, yourself and Stephen, kind of think about managing the assets?
So fundamentally, these are strong cash flow assets, right? And there's 2 things that make up the revenue line. It's how much wind we have, and we touched on that just now, and the price we get for that. Operating costs are, of course, important, but they're typically around 30% of revenue. So you've got something like a 75% EBITDA margin in these businesses. So the revenue line has 2 components in price. We have fixed price instruments that they're based in long-term support mechanisms for the government where they're effectively the counterparty, and then the sale of merchant power. So this year, for example, 68% of our revenues for the year are fixed price and the rest is merchant. So that gives us deliberate exposure to power prices in how we structured the fund. I think that's an important thing. Most investors have negative exposure to power prices in their investments, and certainly they do at home. And when you then come to think about how we manage the assets, fundamentally, as we said, revenue is the key thing. So what do you want to do? You want to optimize that. So we make sure that our wind farms are available and ready to generate so that when the wind blows, we can capture it. We can also improve their ability to capture wind through software and hardware improvements, and that increases the energy yield. We can and have taken action to fix electricity prices. We did a lot of hedging earlier this year as power prices stepped up based on the conflict in the Middle East. And we locked in around a terawatt hour of power at a fixed price for a year. So you can manage both production and revenue in the short term. And then over the long term, we of course want the assets to last as long as possible. So we're very clear that we think about the lifetime of those assets when we look at maintenance.
In terms of kind of how the portfolio is valued, obviously, equity investment trusts are very obviously, how they're kind of valued. Whereas, with any real asset, there's not live pricing for those. So how do you guys kind of go about doing that?
Yeah, no. So it's obviously slightly different from just an investment trust that owns stocks that are marked themselves in the market. So I spoke earlier about the business model is in effect revenue is the key factor. So if you look at your revenue and you project that into the future using your expectations for wind over life and your expectations for power prices and inflation, and then you deduct the operating costs, which are typically fairly boundable and knowable. One minus the other is your free cash flow line. You then, of course, pay some tax. And in effect, that gives you a net cash flow over the life of the projects. And then to get that into today's value, you use a time value of money discount rate. And at the moment, in effect, on our levered portfolio basis, that's set to around 10%. So you discount all those cash flows back to today's value. That's your net asset value. Obviously, really, in reality, the value of these assets are what they're worth when you buy or sell them. So we stay very close to the market and see the prices and see that it validates where we are on a NAV basis.
And there's, a lot of, I think, inflation linkage within the portfolio, and that extends to the dividend, which obviously we've mentioned. Now that is fully and explicitly linked to consumer price inflation, CPI, which kind of makes it sector leading in this regard. And it's really been resilient as well, especially at a time when share prices have been hit. What dynamics play into this?
So as I mentioned earlier, the revenue composition is partly born of government-backed mechanisms. Those are explicitly linked to inflation. And they're all now, in fact, linked to CPI inflation. So that's very clear. And on a present value, so our discounted cash flow basis that we mentioned earlier, that's around 50% of the value of the fund. This year, it's about 65%. So that gives you explicit inflation linkage for those revenues. Power prices have a relationship with inflation. I wouldn't say they're directly correlated, but there are definitely periods of time where power prices are the driver of inflation. We saw that in 22 and 23. So there's an aspect of inflation linkage there that's also helpful. And that's what, as you said, enables us to provide an inflation-linked dividend. It is sector leading, and we're very clear about it with our investors. We don't want to hide behind words like progressive or growing. You can see the increase in our dividend every year for 13 years there as a matter of fact. And as we said earlier, this year's dividend is set at 10.7 pence, reflecting the CPI increase this year.
Now, kind of going back a little bit, obviously mentioned that Greencoat was the first mover, I guess, in the renewable energy infrastructure sector. And we saw a lot kind of coming through, 10 years ago when interest rates were zero. And I think a lot of these kind of trusts were offered up as kind of bond proxies when interest rates were near zero. And I guess they kind of felt the pain there when interest rates rose through 2022. Now we've kind of had that reset, I think. Yes, the 10-year gilt yield is 4.8%, but as you said, UK Wind is a 10% plus or 11% plus even dividend yield, which is more than 100% premium to what you can get on gilts. Do you think we can kind of finally put to bed this bond proxy myth?
Yeah, I think it's a very interesting discussion. I think if you go back to first principles, the value of almost any asset is about its comparison to risk-free investment, which is really just government bonds. And there is a difference between how our cash flows behave and how a bond might behave. So when rates rise, that usually manifests itself in higher gilt yields. And we've seen that since the trust mini budget. But for us, that's typically driven by inflation. And that actually in our cash flows, as we just mentioned, that means that our cash flows increase by inflation. So even if we then increase the discount rate, which is, as we said earlier, the rate that we use to discount all those future cash flows back to today's value, one more or less offsets the other. So on a NAV valuation basis, since 22-23, really the change in rates hasn't affected our valuation that much. It's actually been more about power prices. So they do behave differently. There's doubtless, though, an impact on the demand for the sector at a time when you can actually get yield from other areas. That probably is the more impactful thing, and that's manifest in ours and other share price discounts in the sector. And if you just look at the pure maths of investing in gilts, I think if you invested in a 10-year gilt at the peak of low rates, so 2021 or thereabouts, the drawdown on capital value would have been about 25 to 30%. There's no equivalent drawdown in capital value on UK Wind's net asset value. There is on sentiment. And of course, in the meantime, investors have been picking up an 8 to 9% dividend yield as well. So they behave with reference, but they don't behave in unison.
And what do you see as kind of some of the key risks for investors to think about when considering an investment in UK Wind?
So we've mentioned power prices earlier. That's something that the fund is keen to have exposure to, and it's something that's paid the fund well over time. So as power prices advanced in 22 and 23, we saw dividend cover of 3.2 and 2.1 times respectively. So that was a very strong aspect of performance. But there's another side to the coin. Since then, power prices have fallen a reasonable amount. Now, of course, we've still paid our dividend and protected capital value where we can, but there are ups and downs in power prices. Power prices are relatively hard to forecast in the super long term. And that's why it's important for our business that we start with structurally higher dividend cover and a prudent approach to gearing. So power prices is certainly one area of risk. I think we have to say that politics in any long-term investment is another area of risk. Fundamentally, I think these are assets that do benefit our country and our electrical system. And I think that ultimately the economics of it will be respected over time. But there's clearly a political risk, and you've seen some of the headlines that the Reform and others are keen to promote. All I'd say is it's pretty easy to put out headlines and snippets when you're not in power. There's an ocean of distance between there and actual policy.
Absolutely. Kind of moving on to that, I guess, the outlook and the environment. We have seen a few policy changes implemented by the current government, which we have written about and listeners can find on our website. Can you just talk to a few of these briefly and explain kind of how they impact UKW and what's been done to mitigate them?
Yeah, I think I characterize them as a couple of small changes to the subsidy regime and the way that carbon prices are affected through the electricity market that have had a small impact on our net asset value, nothing fundamental. I think the important thing in all of that is for government to understand and hear the message around investor confidence. We engage with the government a lot. As you know, the production of more of these assets is at the center of the government's target to reduce our dependency on fossil fuels and therefore to stabilize power prices over time. And to have that, you need to have investor confidence. And I think that's a message that government listens to. I think on a more positive note, we think there's a lot more that renewables can do to demonstrate their benefit to consumers. You will have seen the possible introduction of something called the wholesale CFD, a contract for difference. And the idea of that is in effect that you would offer existing generators, so this isn't just for new generators, but existing renewable generators, the ability to sell their power at a fixed price over a period of time as yet undefined. We think this has the potential to be a really, really powerful policy statement. And this is something that we've advocated for a while. So if you think about it, our investors should be content to take a slightly lower power price than is projected in order to de-risk their exposure to power prices and have a fixed price. And for the consumer, it delivers savings. So if this is implemented in the right way, it's actually quite a powerful mechanism for bringing the benefits that renewable bring to the electricity system into the hands of consumers. So that's something that needs to be explored further. Again, we'll engage with government. There's a consultation later this year. But we think that's actually has the makings of a very decent policy that can be good for both investors and consumers.
And we mentioned already, there has been some pushback from some quarters on the route to net zero. Yet arguably government policy for now certainly will remain supportive, as do things like demand for data centers to kind of fulfill the artificial intelligence electricity demands. How do you see things evolving as the debate continues? And are there risks, as you mentioned there, when we look towards the next election, albeit that's still a few years away?
Yeah, so I think to answer that question, we have to zoom out and look at where the UK is. So in effect, we're on a huge electrification journey. And I don't need any sort of fancy slides to show that. I think you just need to think about your own lives. You look at you look at the prevalence of electric vehicles, heat pumps. You start to think about how much you use in terms of data center capacity. I certainly use ChatGPT, Copilot a lot. I know my kids do. All those cat photos that are on your phone, they take up capacity in a data center. So you can see that there's a lot of electrification happening of fossil fuels through cars and through home heating, and then there's new sources of electrical demand, data centers. So when you think about that structurally, fundamentally, we're going to need a lot more electrons going forward, and there's a range of forecasts as to how much you'll need. Maybe in the next 10 years, it could be 50% more electrons than today. It could be 100% more. And really that depends on how much data center capacity grows in the UK, the adoption of electric vehicles, the adoption of heat pumps at home. So if you're on an electrification journey, you're going to need more electrons. Even if you come to power in 2029, for example, you're quite a long way down that track. It's quite expensive to change course. So then the question becomes, well, where do the electrons come from? You look at nuclear for a second. So I've no philosophical objection to nuclear. I certainly think it has a role to play. But if you look at the plants that are being constructed now, the subsidy award for Hinkley Point was in 2013. Now, of course, there's a lot of first-time design, but you're not going to get the first electrons until 2030. And when you do, it's at a price that's materially higher than renewables. Sizewell will probably be a bit quicker to deliver because it relies on some of the design work. But again, these are projects that take a long time to deliver. So the prospect of having further nuclear capacity than that, which is being built today in the next 5-10 years, I think is relatively low. So then you look at conventional sources of generation, you look at gas. Leaving aside the volatility in gas prices, which we're getting a reminder of at the moment, it takes about 5 years to build a new gas plant in the UK and frankly all over the world, simply because of the demand for turbines. So it's relatively slow to arrive, and it's also more expensive than renewables. The government's own estimations of this were shown in their publication around the most recent contract for difference for renewables. They put it at about £150 a megawatt hour, and renewables are roughly half that. So those sources I think are challenged in terms of expense and time of delivery. And then you look at renewables, a consented solar farm that has a straightforward construction profile could be 6 months, 12 months. Onshore wind will take a bit longer, and grid is probably the key bottleneck. Offshore wind takes a bit longer still, but you're still looking at a horizon that's way less than 5 years. So then when you think about it, if you're going to need the electrons, where are they going to come from and at what price? The renewables is the solution to all of that. So I think if you just think about it from an economics perspective, and I haven't mentioned carbon once, I think renewables will still prevail.
Absolutely. Now, in terms of capital allocation, to move back to UKW, there are obviously a few kind of levers to pull. I think we spoke about this last time, so I'll kind of slightly reword the question a little bit. How's the conversation and the thought around whether to prioritize share buybacks and dividends versus debt repayment and new investments kind of evolved to?
No, it's a good question, and capital allocation is obviously a key aspect of managing a discounted investment trust in today's world. So I guess the first thing to say is that we're a business that has structurally higher dividend cover than others, so it generates organic capital every year. So we're not reliant on disposals, we're not reliant on capital markets to be able to have capital to allocate. If you're in an investment trust that has much lower starting dividend cover, you really have very little organic capital arriving every year to reinvest, and all you have is the ability to reborrow money that you may have amortized. So we're in a structurally stronger position to have capital to allocate in the first place, and I think our investors like that about our model. So then what do we do with it? Well, we've been very clear on our dividend, unambiguously clear. It's going to increase in line with CPI. So that's the very first port of call. That's valued highly by our investors, and the track record of delivery the same. So where do you then go? We feel that the business will benefit from a little bit of de-gearing. We paid off £30 million of our RCF at the end of March. We think there's probably more to do there. Buybacks, I think there is a case for them as a tactical means of investment. I think personally for this sector, for funds that have assets that have limited lives, if you have recurring buyback programs, and we've spent 200 million on buybacks so far, it's undoubtedly economically additive to your investment. No one can argue with that. If you can buy your own assets back at a 25% discount, why wouldn't you? But if you think about the longer term, and we covered this in our full year results, you're really just heading to a business that in effect is in wind down, because you're not reinvesting. Every year your assets get older by a year and they have a finite life. So in our view, tactical buybacks have a role to play, but recurring buyback programs are in effect a way to wind the fund down. And of course, if that's what our investors wanted us to do, they have the opportunity to tell us that every year, and also as part of roadshow engagements to deliver that message. We don't feel or haven't heard that that's the message. And therefore, we think that this year is the right time to make a disciplined return to reinvestment. Because fundamentally, the cash flows that service the dividend in the future are just augmented and compounded by making good investments today. And there's a lot of opportunity ahead of us. There's some in our own portfolio. There are some sites that we can think about repowering, or at least getting the optionality to repower. There are also adjacent investment opportunities. So we think for the long-term sustainability of the dividend in the business, which we feel is the core of what our investors want, the case for reinvestment is pretty strong.
Yeah, and in terms of that kind of return to reinvestment, I mean, have you kind of used the time away from new investments to kind of build up a bit of a pipeline of things that you want to kind of maybe get interested in?
Absolutely, yeah. We're always surveying the market for opportunities. We think there are a decent number of opportunities within our own portfolio, actually. Ones that I would characterize as probably relatively low cost, high optionality. So that's things like extending the leases on our wind farms to permit a repowering, or just extending their operational life through investment. Those are fairly low cost, but they have decent reward. Beyond that, there's quite a lot of opportunities. There are plenty of sites out of allocation round 6 and 7 that haven't been built that will require capital. And as I said, there are even some opportunities adjacent to our own portfolio where we think we could make investments. So I think you'll have to wait and see more, but we've been clear that this year we'll see a return to reinvestment, and we're working hard on that.
Great, that's a really good run through, Matt. I think hopefully some real kind of food for thought for listeners. So thanks for your time today.
Thanks a lot, David.
Now, if you do want to know more about UKW, we'll link to our latest research note in the description. You can also find plenty of feature articles and results analysis on the Kepler Trust Intelligence website, as well as going away and exploring UKW's own website and its portfolio. Thanks for joining us today, and we hope to see you soon. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It's strongly recommended that if you're a private investor, independent financial advice should be taken before making any investment financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorised and regulated by the Financial Conduct Authority.